Good morning. I'm Bob Annibale. I head up inclusive finance at Citi, and we've been partnering with Skoll for almost 4 years now in this whole area, pretty much around finance and inclusive business and the range of things that you do, which has many areas and not just around finance. But all of you have a component of that and of the challenges of what is very commonly discussed of reaching scale. It's always what we're tasked in hearing about, and as we listen to it, many of you are also tasked with the usual language of, can you do it at a sustainable, financially, commercially sustainable level, which is a big task to ask, in my mind, many organizations which are, in essence, almost all providing public good as a key component of your work as social entrepreneurs or enterprises. To use the same benchmarks and models that we very often would have used in looking at other enterprises. And it challenges those of us who are doing finance in this area, whether it starts philanthropically and it moves across the spectrum to funds or multilaterals or bilateral development agencies, as we'll hear, or it goes to commercial banks. How do we understand and assess the work you do? And in many ways, how is that going to be in essence scaled if finance is the impediment or not? So we bring that as one of the issues. The other is that in order for almost all of us, our experience has been one around partnership. And that the collaboration, since no one of us fills those needs, has been very important. I think we'll hear that also from Charlotte. Because it is about, and certainly for the case of Citi, whether partnering with people like Skoll or some of you around an issue, or our large corporate clients, or in some cases governments. Without that, we could not ourselves come up with a structure, a mechanism that might either allow greater outreach or greater scale, if those are the measurements that you're looking to have. So I don't want to spend much more time on that, but we will come back to a little bit later maybe some of the impediments or some of the achievements you've found in achieving some of these structures and in terms of scale. So there are three people on the panel who I want to have them introducing a little bit about themselves. But first, let me just talk. Elizabeth Littlefield, sitting here, is somebody I've known and worked with for very many years through a number of phases in her career, from the banking role to at CGAP, where I sat on her board or executive council, which is the consultative group to assist the poor at the World Bank, to being the CEO of OPIC, which oversees Private Investment Corporation, which is the development finance institution for the United States government and takes risk and financing in many of the organizations and the areas of work that all of you are a part of. Peter Tufano, who some of you might know, he's the Dean of the Business School here at Said Business School. Many of us would have known him from his many years also at Harvard. He worked on where else was it that I first met Peter? I guess at the FDIC, we sit on a committee together in the U.S., which is really about economic inclusion, chaired by the FDIC, one of our key regulators in the United States in the financial system, and who has done a lot of work also around consumer finance challenges. And I think of that in the U.S. particularly, but I know Peter's done it globally in his role here now too. And Doorways to Dreams, also a very interesting organization. Nonprofit, I think it was nonprofit, isn't it, Peter? That Peter helped establish also based out of Boston, and for which he's done a lot of work in areas where he himself probably has to think about how you fund an organization that's a nonprofit that has, in some ways, almost a consultant. In some ways, it's a research organization. It's certainly a lab for testing, and it's been a great influencer. But how do he's had to wear many hats, I think, in his funding. And then also, Charlotte Oades. Now, Charlotte is very interesting and from Coca-Cola. She's had a very diverse career at Coke and along its business lines of Coke and the marketing side, I believe, of Coca-Cola. And she was also the CEO of Coca-Cola in the United Kingdom. So she's seen many aspects of it. But she's really taken on the leadership globally with Coke, which is a huge organization, as you know, made up of not just their own companies, but of hundreds, if maybe more than that, of bottlers and employers and producers and distributors all over the world with a real iconic brand on the women's economic empowerment front. And trying to embed in their business model and in their suppliers, I would say, and those who distribute their products and those who who design and manufacture it, the role of women. And an important part of that are some programs she might speak to that really get to the last mile, then also work something called 520. She can explain that role for you too. But they've had to impart in many ways on finding partnerships and influencing the way that Coke can be a convener around both funders, whether it's philanthropic or commercial or microfinance or elsewhere, but in really building out the women's empowerment in terms of those who can build businesses and programs around this and where that leads to. So, that's the sort of scope of the three people, we're talking to here. And before each one speaks, please, they can say anything they'd like about their organization too. But I wanted to give it how we saw the three coming in. And I wanted to start, though, to ask Peter, really, to speak first, to help us frame this discussion, because so much of what some of you are here, I know, come here as impact investors, some as social entrepreneurs, there's a vast use of terms here for a lot of maybe common approaches. But what is that landscape also that we're speaking about in terms of some of this new funding and finance to the areas that Skoll and many of you work on? Peter, could you?
Thanks. So I'm a dean and a professor and also a social entrepreneur, but the dean/student in me suggests that you answer the exam question. And so the exam question here is bringing in the big money. So I thought maybe I'd just start by just laying out the groundwork here. There are lots of needs that need to be addressed. They are environmental needs around soil and about air and about water. There's educational needs, there's health needs. It all adds up to a lot of money. And so in preparation, I was trying to figure out how big are the pools of money that we might access. And I thought I would just throw out a bunch of numbers to just get it started, because sometimes we tend to have an Audubon vision. We tend to look at a single object and we don't see the context within which it exists. So apologies that these numbers may be a little bit off, but just to give you a sense. I'm going to start with a big number, but it's a new number that you may not know of. The Indian government has recently changed the Companies Act in India and required all major companies of a certain size to spend 2% of their average net profits on CSR activities. That's $2 billion. All right, everything will be in dollars. Then let's get another one. A lot of us are excited about P2P. And some of it's retail and some of it's kind of at the business level, but all of P2P, and this number is wild and woolly, let's say that's about $10 billion. So maybe 5 times as big as the Indian thing. Others are excited about impact investing. Again, these numbers are very imprecise. But maybe most recent numbers that I saw from the end of last year, 13, 15 billion, something in that order of magnitude. Big numbers. Let's get a little bit bigger. Some of the organizations represented here, Citi and Coke, are part of the corporate giving world. The US corporate giving world is about $17 billion. And this is annual flow in terms of not the balances, but the flows. That's pretty big. How about the traditional philanthropy world? US philanthropy annual giving from foundations, not from individuals, $50 billion. In the UK, that's 2.7 billion pounds, so think of that as 4 billion, and continental Europe, another 4 billion. So 50 billion in the US and 8 billion in continental Europe and the UK. Bigger numbers. Remember, I started at 2 billion and we're up to about 50 here. A little bit bigger than, actually we have to jump quite a bit for the next couple. Individual giving in the US, 240 billion. I couldn't find the numbers in Europe, but I'm sure they're considerably lower on a per capita and total amount of basis. Then there's corporations. Now this one's really complex. Do you want to look at total spending by corporations or maybe CapEx or something? These are really wild numbers. But CapEx, for example, in the US, 2 trillion, so 2,000 billion, right? So just, again, orders of magnitude. So that's a fairly big number. And then the US government, federal spending, 3,600 billion, so 3.6 trillion, all spending 6 trillion. So we started at 2 billion for the Indian government CSR activities, all the way up to 6 trillion for the US state and local governments, federal, state, and local governments. And those are the pools of capital, I think. And I haven't put in banking. Banking and investments, at least in the US, is probably a $4 trillion business. So again, we can either capture a very large share of reasonably small pools or a very small share of very large pools. and to set it out. The size of the investments required to do all the things that we want to do are massive. And it's probably useful, at least in my context, as I think about the big money, to lay out all these various ways or various pools of money. So getting 30 basis points out of a government is probably 10 times as big as getting 100% of all impact investing. So I just wanted to set that stage so that when we talk about how is it we're going to get all these important things done, we don't simply say, which is my natural tendency, let's talk about peer-to-peer lending. Let's talk about impact investing. Let's go to India and think about how we can harness this $2 billion. That's all really important, but we can't lose sight of the fact that there's a lot more out there in a lot of pools that are 10, 100, and 1,000 times bigger. So I think I'll just start with that.
That's very helpful in setting the framework. And Elizabeth, you work for development finance institutions, and you've looked at this area of financing social enterprises and entrepreneurs in all sorts of areas for many years. Maybe give a sense of OPIC's role and then where you view this in this landscape.
Great. Thank you, Peter, and thanks, Bob. I want to just come back on your numbers for a second because that was a very helpful landscape, and then maybe mention a word about OPIC's role in all this. People in the impact investing space have often talked about these huge numbers, how the market's going to grow to be 50 trillion billion. And I get really nervous when I start hearing that because we've all seen markets where the hype gets ahead of the reality. And then the disappointment is inevitable. So for me, I've often talked about how in impact investing and social entrepreneurship in particular, there's those that would say this is the biggest thing since sliced bread, it's going to take over the world. I call those the breathless maximizers. And then there's the people that say this is nothing, it's chump change, it's never going to be important to the mainstream capital markets. Forget it, marginal. And those are the derisive minimizers. And in fact, the world is, for me, somewhere in between because all we really care about is how big is impact investing relative to the amount of money that's spent by governments and philanthropists solving social problems. So we don't need it to be a big chunk of the financial markets. We just need it to be big in relation to money that flows into aid because that's what we're trying to displace. The more we can take out of the aid bucket and do it in a sustainable way, the more money can be reserved for those truly intractable problems that can't be solved through business models. I mean, would you agree with that?
Well, that can't be solved through business models. That's a discussion, I think.
Okay, well,
all
let's
right.
come
So
back.
where is that line?
We're going to get there, too.
Yeah.
So just maybe a word on where OPIC sits in all of this. Our numbers are not anywhere near as big as yours, but they're still pretty substantial in the development finance institution world. My agency runs a portfolio of about $18 billion. We're active in about 106 countries. And as Bob mentioned, our role, our mandate is to help stimulate private capital flows into sustainable economic development, to address development challenges throughout the world. And of course, we do that by providing financing guarantees and to a lesser extent insurance to back the investors and sponsors that are investing in those challenging development projects. And I see in the room many of our partners, small and large. I see Willie over there, Willie Foote. We've worked with Root Capital. We've worked with Coca-Cola bottlers, in fact. So our financing instruments, the normal toolbox is a range of anywhere from $1 million to $400 million in terms of project size in loans, guarantees, and insurance. In the last couple of years, we've introduced a number of really interesting, and maybe we can come to this later, adaptations or products specifically designed to support impact investors and social entrepreneurs. So we'll come back to that later on.
Okay.
But just in terms of the context of these number flows that Peter started us with, I think what's interesting for me is that people have finally come to understand that private capital is a critical part of the solution of all these development challenges. And that was completely not understood, 20 or 30 years ago. When OPIC was carved out of AID 40 years ago, at that time, the flows into emerging markets the vast majority of them was ODA, Overseas Development Assistance, and only a little bit was foreign direct investment at the time. And in the 40 ensuing years, since we were created, that's completely flipped. And now for every $1 that goes into emerging markets in philanthropic capital, ODA usually, $7 is going in terms of FDI. So I view our job as the development finance institution and our sister agencies like ProParco and IFC and CDC and FMO to be harnessing those private capital flows that are coming to these markets and making sure that they're being channeled to things that are the most positive. And we've seen this DFI model, the OPIC model, growing, along with those foreign direct investment flows. So the Center for Strategic and International Studies did a great study a couple years ago that showed that the DFI model of doing development is growing at about 10 times the ODA model. And 10 years ago, together, the development finance institutions were financing about $10 billion, and now it's almost $50 billion. So, the tools that governments have to help stimulate these private capital flows and direct them in the service of development is growing quickly.
And I'll just sneak in one thought of that from both views. That I often look at the sense that many of your organizations, Skoll supports and others, are actually providing public good. They're providing public services. And so I always feel it's an unfair benchmark when people say to me, well, what commercial model do you use to finance them? I mean, what's your risk assessment, this, that, and the other? When in fact, if you did that, you'd never finance any kind of public works. You wouldn't have libraries, health clinics, we wouldn't have child care centers. We'd have very few things who are providing a public good. And what maybe shift over time, or we hope will, is going from viewing that as government aid to government contracts. The government actually contracting and recognizing that you're performing services on its behalf, in which case you have a different sort of cash flow coming, a more predictable one, more performance-based, output-based in a sense way that a public good can be assessed by and funded, but also then allows organizations to get more normalized range of funding, for working capital and otherwise, that today they don't have to go to a specialized impact fund for, or try to sell a story to in a deep way. But that would shift from aid to real government contracts to recognize the work you're doing is in the public good. So I'm going to then turn over to Charlotte, because I think Charlotte it's very grounding to be able to have a very large, iconic name like Coca-Cola working in this space, and who itself, of course, has access to all the finance and capital out there, and people fighting for their business to be able to support their growth. But then to be working deeper into producers or distributors of yours, particularly looking at women, and then for that to be successfully a part of your model, Charlotte, how you're coming aware of and helping to influence their challenges in raising the finance.
I think, well, let me start with just the broad framework that we think about globally. So when we think about the social impact that we want to have for the Coca-Cola Company, we think about it as the top 3 priorities for us are women, well-being, and water. And I can go into a bit more detail, but I'm really going to focus primarily on women today, as Bob has asked me to do that. So when we think about this, we believe it is absolutely critical that to grow a business, any kind of business, that you have to have a thriving community. And it's particularly important for us at Coca-Cola because I know we're really well known for our global brands, but we are essentially a local business. We literally are in every market in the world except for 2 today, which is North Korea and Cuba, although Cuba is clearly opening up. It's absolutely critical that those communities are thriving and that they can support healthy business growth. As we look at that, we know that there's absolutely no way that we can do this on our own. Some of these social challenges, as we all know, are difficult and they're complex. So we come to this with absolutely partnership in mind. We know that we need to partner with many different people, and we talk about this as golden triangle model is what we refer to it as, because it has to bring together, in our understanding, government, civil society, and business, so all 3. So the program that I lead globally is known as 5x20, to give one example. 5x20 is our global commitment to enable the economic empowerment of 5 million women entrepreneurs by 2020. And that's either helping those women to set up businesses in the first place that somehow touch our value chain, and if they don't, or they might have a business already that does that. But what they don't have is they don't have typically access to any kind of business know-how or training, they don't have access to finance, and they don't have access to peer groups or networks. And maybe they need all of those things. And we try to help them overcome those barriers to that business growth. The reason that we try to look across our entire value chain, whether it's right the way starting with agricultural producers or right the way through to post-consumption and making things from recycled packaging, is because we believe fundamentally that if you can link it to the business in some way, it will be much more sustainable. Doesn't mean to say that there's not a place for philanthropy. We have a philanthropic foundation. We work with many other philanthropists and other foundations. It's great for catalytic funding. There's a place for it. But what I try to do on 5x20 specifically is create sustainable businesses and livelihoods for those women. And why women? I think we all know because they have a significant and disproportionate impact on the growth of the economy in the local community. If you can empower a woman, you literally can recharge that local economy. So that's why we're so committed to it. So a couple of examples within 5x20. One would be the Philippines. The Philippines was one of the first markets we started to work in, one of 4 actually, back in 2011. We knew from working with our local team in the Philippines and talking to some of the NGOs we already worked with that there was a huge need for women in the Philippines. They weren't highly educated. There are over 800,000 sari-sari stores, which are those tiny little neighborhood stores. Sometimes they're small kiosks, sometimes they're street carts, sometimes they're just holes in the wall in somebody's home because women can't travel very far from their home. But essentially, they were struggling to grow those businesses because they hadn't had the education and training. So we worked with TESDA, who are the Technical Education and Skills Development Authority in the Philippines, a government agency, who provide vocational training on many different levels. We shared our curricula for business training of small stores. They shared their entrepreneurial training, and we agreed that we need to first start with capability building before the access to finance. So we started to pilot a program in about 300 stores in Palawan, the province of Palawan. And now we are absolutely really moving very quickly. They have just increased the target that they want to reach by 2020 to 200,000. So what we're finding is that through then that capability building, we then worked with TESDA and the local community to identify the next need, which was access to finance. And the access to finance, we eventually partnered with 3 different MFIs that gave us national coverage across the Philippines, but very, very local connectivity for those small local businesses, which is what they wanted on the ground. And we don't provide the finance in that instance. What we do is we connect skilled, capable women who've been through that training to one of those 3 MFIs locally. So that enables them to reduce their risk of actually finding a market access, train people that they can then work with, and it enables the women who otherwise wouldn't have necessarily the collateral or the access to that to find that training. So that's just one example, and we continue to do mentoring and support through that. Another completely different example might be the partnership that we have developed with IFC. So for example, in Nigeria, IFC has made available $100 million. And they do that through a risk-sharing facility through their local relationship banks. And so the first tranche of that is in Nigeria, where we have made a commitment across Africa that if we are going to put new distributors in place, it's an absolute choice that 50% of those will be women. They have had very great difficulty in accessing finance because, again, like many of the women, they have the similar challenges, not necessarily the collateral. They don't or haven't had all the educational training to get that. So what we do is we work with IFC. They have identified Access Bank in Nigeria. They will share the first loss of that risk sharing. They through the fact that we will train all of those distributors in all of the business skills to run that business, it reduces the risk of that business being a higher risk for Access Bank. They have the additional risk-sharing facility on first loss, and that enables them to reduce the cost and pass on that saving on the loan price for those individuals. So they're very different models, but those are the kinds of things we do, and it's very much for us about how can we bring the skills that we bring to the table, which in those instances are clearly business skills, understanding where some of these women can be reached, and connecting them with other critical partners that will help us to scale. And obviously TESDA has, in the Philippines, access to 161 sites for vocational training. So it also enables us to access those women in the local neighborhood so they don't have to travel, it's safe for them, and it's the kind of partnerships that really make sense to us.
Great. I think, and there's also never to be understated the value you bring if they become a supplier or a distributor to Coca-Cola. In the minds of any financing or others, that immediately wakes them up because their association with a company that has access, such influence and access, is in its own right incredibly important. And it's work that, at Citi, I know we do a lot with OPIC. I mean, we just finished reaching another threshold of financing of microfinance institutions together that some 50, I'm looking at my colleagues if I get it wrong, some 50 institutions about, 22 countries, Moshe, of $400 million, 1.2 million, 1.2 million borrowers, 1 million women. So we've just reached financing about 1 million women under a platform that really is a multi-country, a facility that in partnership with many local institutions, and this is all in local currency under local law, complex in each case, and folks like Mitchell and others, so instrumental in doing this. But can reach 1 million women is a large number. But it was about, again, this connectivity between a development finance institution taking risk in this, doing an important risk that wouldn't have allowed Citi to go out to that scale or to the years that we do, and then work with so many other institutions. And it's a program which is now going to move into beyond that microfinance into other areas of inclusive finance and everything from water and sanitation to work that some of you do. But
maybe just mention why it's so complementary.
Go.
After you?
No, please.
No, I mean, the reason this works, and it's about a $2 billion relationship now, is Citi's got the branch network and the local currency capabilities, which OPIC doesn't have because we're all in Washington, whereas we've got the risk appetite to do risks that Citi won't do on its own balance sheet. So it works because they're originating deals through their local offices that the local offices couldn't do on their own because of the risk. They're bringing it to us, and then we're providing a 75% guarantee on those deals. So it's a perfect synergy between the capabilities of two fairly large organizations, but either of which couldn't be reaching 1 million people on our own.
Thanks. Peter, you had a response or a signal when Elizabeth mentioned something about can't always be solved by business models. How much of what we're trying to do, and because here at Said you have programs where you yourselves are teaching the social entrepreneurs in the MBA programs and in other specialized programs, but how much can't be reached, really? I mean, where is that boundary and that transition?
I want to pick up what Charlotte talked about. So, if you simply showered money on the people that you're working with, it probably wouldn't solve the problems that they need to solve. They need a supply chain, both for goods coming in, they need a distribution channel for goods going out, they need management skills of a certain type, and I know the program, your 5x20 program, provides that as well. And so one of the questions that we ask systematically is, where's the bottleneck? Is the bottleneck finance? Is the bottleneck something else? So I'll reflect for a moment on my little nonprofit, and it's a little nonprofit. And we have one of our funders in the room, I won't identify them, and I shouldn't say what I'm about to say, but if they'd given us 10 times as much money, it's not clear we would have done 10 times as much work. The partners that, that was really important, but what was even more important was partnering up with various corporations because we didn't have the distribution channels, we didn't have the product capabilities, and money is just not enough. And so I think, I would kind of reframe the exam question again. So it's about bringing in big money, But you really need to bring in not just big money, but it's often big money plus supply chains, plus training, plus, because at least when we look at our students have no shortage, as the people at Skoll, no shortage of great ideas. And simply showering them with lots of money will not, probably, in my humble opinion, get the solutions to these problems, because it's all the rest of the stuff that takes a business to succeed. So I will close, but just simply to say, you know, there's no social enterprise marketing, there's no social enterprise operations, there's no those are consistent across various kinds of entities. And many entities fail, social or non-social, because they need to get those elements right. So, and that's why I pushed back a little bit, because I think that some of the more successful solutions are ones where you have to leverage corporations and other large institutions, not necessarily for money, but for all the other things that they have.
Can I build on that? Because I think you mentioned in your opening Project Last Mile, so let me just build on that, because I think we get a lot of questions about, well, why don't you put all this stuff on your trucks and just deliver it to the furthest points of the world? And that's not possible, because if we put all the other stuff on the trucks, then we wouldn't be able to deliver anything else. But what we can do is we can share our logistics and supply chain and all of that distribution know-how. And that's exactly what happened in what we call Project Last Mile. So it came about because we were asked the question, well, why can't we get, if we can get a Coke, and I see it everywhere, why can't we get medicine to the furthest points of the world? So we worked with the Tanzanian government initially, and then Ghana and Mozambique governments, to actually share with their government agencies our expertise in all those of the areas in partnership with our bottlers. And essentially what has now happened is, instead of, to use Tanzania as the example, instead of about 500 different drop-off points, which wasn't getting that last mile, they now are equipped to go to 5,500 drop-off points. It's reduced it's enabled the access significantly, and we even have cooling engineers that obviously work on our cooling technologies to keep things cold, to help them to understand how to do that with their cooling systems to keep the vaccines ready. So it's a completely different value. It's not necessarily monetary value, but it is valuing know-how and expertise and passing that on to build capability.
An outreach that would be so costly to replicate, but to run on top of that platform, these other services is very interesting. Elizabeth?
I think we all agree that we hear entrepreneurs in the social enterprise sector saying, there's not enough capital for me to run my business, and then you hear investors saying, but there's not enough investable businesses to invest in. And so the question is, where's the truth in that? And I think we're all saying it's really more about building, building the infrastructure, or whatever you want to call it, the ecosystem, the plumbing, the financial intermediation capabilities in this nascent field that's going to connect the right investments with the right investors, the right types of capital at the right stage of a project's or company's evolution at the right time. And I think that's been the critical thing that we've been focusing on. And I know many of you in the room have done the same thing. But for example, we have so impact investors, or even mainstream private equity investors that want to get into emerging markets and sustainability, coming to us saying we can't find the things to invest in, and if we do find them, they're too small, they're too isolated, we don't have the origination capabilities, we've got no experience in these markets. How can you, OPIC, with 40 years of experience, help us? And on the other end, you have the entrepreneurs coming to us saying, we need not your services, but we need a much smaller amount, and we need equity rather than debt or whatever. So we've created a bunch of new products and platforms that hopefully aim to bridge those gaps. One of them we're calling the Aligned Capital platform, where we're sort of showing our pipeline to potential investors so they can come and investigate what we're seeing and what we're looking at, and hopefully bring capital together with those investment opportunities. But anyway, I want to just offer up that I think we're all seeing this need for the plumbing, the architecture, the ecosystem around the capital that's going to make these investment opportunities come to life.
Great. I wanted to, take advantage because we have people in the audience who I know, and my colleagues know, and all of you, who also can add to this dialogue, and either in question or response. But there was some work that I don't know where Andrew went. Andrew Stern. I saw him walk in. There you are in the back. I can't see where anybody went to after they walked in. But Andrew was over at Dahlberg, did some work on his global development incubator, but some work also on how businesses were doing this you did a survey of a lot of companies, and it gave, I guess, a snapshot into this. Yeah? Can you give us a little feeling? Because you've looked at more than the few of us up here and worked with some of us as well. So I just thought you might add something.
Yeah, thanks, Bob. So we, with Cities Support, had done a study on innovative financing in development, and looked at basically what we saw was a gap was significant amount of private capital out there seeking alternative investment, seeking frontier market investment, and a significant amount, as Elizabeth said, of public capital that can help take this further. And one of the big gaps we saw was around the intermediation, and OPIC's pursuing this aligned capital. And a couple of things that we saw coming out of our report and survey of the market. One was there's still a significant amount of search and transaction costs between the public and the private capital, even for bankable deals, still being able to close them, whether it's doing the last mile structuring or helping to translate and facilitate across the two sectors. Second was a bit around the information asymmetries. So we'd heard from our colleagues at Citi, one of the most valuable things would be a database and benchmark of comps, being able to provide a little bit more data. As we've heard, there's no shortage of structuring expertise at the banks, at the financial institutions, or here in this room. It's more being able to create a little more transparency in the market. And then a third is there are a lot of new instruments. So I think people have been talking a lot about development impact bonds. Not many of these have actually closed yet. So being able to try to find some ways to help move these a bit further along. So somebody once said to me, it's a bit like getting the first olive out of the olive jar. The first development impact bond doesn't make a lot of sense if you're just trying to do malaria in Mozambique. The cost to set it up is too expensive, but the benefit of getting that first one done is significant for the financing community. So those were a few of the things we saw as we looked at the public and private side.
Okay, there's one other group that did some interesting research on this, then I'll open through to more questions. And Bashka is here from Monitor, from Tufts. Bashka Chakravarti, I can't see.
Jen.
Oh, all the way back there, next to Jen. Yeah, I mean, you did this report as well. If you could stand up, it'd be great, just because I couldn't even see it. Just on sustainability, inclusive activities, why companies aren't doing enough. And your own findings, because you've done a lot of work on sustainable, inclusive business activities. But to what extent this leads to scale sustainability, or is it CSR? I mean, how do you perceive it? What came out of that research?
Well, first of all, thank you for cold calling.
Yes, everybody here. Good luck if we saw you walk in the door. I feel like Peter today.
Would have had my 4th cup of coffee in advance. So part of the scale challenge is what Charlotte was just alluding to earlier, which is that there was a historical approach to the way corporations approached this issue, which was philanthropy. And philanthropy can only go so far in terms of scaling up corporate interests and corporate incentives and aligning it with the size of the needs that they have to go after. So there's only a certain amount of money that gets allocated to philanthropy, and that money is discretionary. So in good times, it's there. In bad times, it's taken away. And so the real challenge is, how do you get social impact to align with business impact, core business impact? And many of the examples that both Coca-Cola has and several other corporations have, where they have been able to find a convergence between business interests and the interests of growing the community of people who are affected by the business. That's where scale happens. And part of the challenge here is for companies to recognize that if they do not invest in currently unprofitable segments of the market, they will not be able to profit from it in the future. So it's that recognition that we need to invest now. And that does not align with managerial incentives, because managers are held accountable for relatively short-term results. And so that disjoint between the long-term payback and the short-term incentive system sort of works against the kind of long-term investing that needs to be done within companies. A second major barrier that we found, and this is, it seems obvious when you say it, but a major barrier was just simply language systems. Most corporations don't recognize words such as social impact, inclusion, shared value, and so on. So many companies, they have, you tell them something along these lines, and they say, oh yeah, we have a CSR department. Why don't you go and talk to the VP of CSR? And that person is usually put in the annex of the annex somewhere. And really, for most CEOs, this is a job that's delegated to somebody else. A couple of years back, I was at an OECD meeting in Paris where the topic of the conference was responsible business conduct. And I made the comment that we should take the word responsible out of it, because the fact that you have to qualify it suggests that the rest of business is not terribly responsible. So this is something that is almost a mindset that is missing in a lot of corporations, and they're beginning to develop this. As they go deeper and deeper into the developing world, they realize that you do have to think about the business model in a very different way. Transporting the business model from the from the Western Hemisphere to the Eastern or the North and South, doesn't necessarily work. So you have to kind of invert that process. Another point, and I'll just stop at here, a major barrier to many corporations is that they recognize the challenges ahead. The problem of the last mile is where they are most uncomfortable, because it's the last mile where corporations don't do very well. Coca-Cola is a complete outlier. Most companies don't have the infrastructure or the capabilities to deal with the last mile. And that's where the NGOs, the social entrepreneurs, the local small and medium businesses become incredibly relevant as partners. And to be able to make those partnerships work, to be able to align the objectives of the corporation with the NGO is a critical task to be able to close that last mile. So I'll just pause here. Thank you.
Thank you. Thank you, Batra. And again, that work's being done at Tufts University in Boston. I'm going to ask just for a moment for some of the social entrepreneurs to respond in a way, because the challenge comes up of, do you scale yourself, or are you an influencer, are you an advisor, are you a partner with those who can actually draw on much greater amounts of capital or infrastructure or brand or whatever to influence that change? Because many have, began with the concept that their own organizations needed to get to this scaling. Scaling is such a big term all the time. It's used all the way. That and commercially sustainable models. I hear it so often, and yet I'm not sure it made sense. And for all the areas you're in, whereas we'd like to think a little bit more about that too. Maybe there's one or two people who could talk about that. Willie, you're here, and you've got Willie. Where's Willie gone? Yeah. There's Willie. And Willie Foote at Root Capital has clearly been someone who's been able to access finance for the work he does, but also probably working with some very big iconic brand names can be an influencer of the change of their buying power. So maybe just this connection we're talking about, Willie.
Sure. Wonderful panel. It's really great to be here. So we've been actually involved in one particularly interesting example where, building on the last comments, in this case it's actually an industry-wide challenge. In this case in the coffee industry, that's almost forcing pre-competitive collaboration amongst industry players, but that they need to create, and we all need to create blueprints for that kind of collaboration amongst all these different players. And many of you will have read about the coffee leaf rust crisis, which is really just decimating coffee production in Latin America. 70% of production in Central America over the past couple of years has been affected. 500,000 coffee-related jobs lost, $1 billion+ in revenue. But what's been really interesting is that it has galvanized action from a bunch of different players, including policymakers and industry leaders and the international development community, to try to improve the livelihoods of the farmers and to stabilize the value chains, the global value chains that rely on those farmers. And so partner-wise, we have Keurig Green Mountain is involved, Starbucks is very involved, all the way over to the other end of the continuum, like an Equal Exchange and Cooperative Coffees, more activist companies. We have USAID through the Global Development Alliance and the DCA on the guarantee side involved. IDB, Multilateral Investment Fund. And then Skoll provided a grant to help to kind of, on the startup, if you will, the conceptualization of this blueprint. Root Capital is involved. We have a network of local NGO kind of partners on the ground in Latin America. And we're kind of co-investing in 3 buckets. One is long-term loans, 7 to 10-year loans with guarantees from USAID to basically refurbish the farms with rust-resistant varietals and then getting long-term market commitments, contracts from Starbucks and Keurig and so on to guarantee the offtake. So kind of deeper market engagement as we're trying to address these very difficult financing needs. Second, advisory. So we're doing a lot of finance, Root Capital and others, but we're kind of leading on the financial management training. So the farmer cooperatives that are investing get better at running their cash flows and coming up with the loan applications and developing internal credit capacity to on-lend to the individual farmers. And then on the other side, agronomic training. So actually, and this is really interesting, where the corporates are putting in, for every dollar they put in, and in one case, they're actually booking it as cost of goods sold. It's not coming out of the foundation. It's being matched by USAID, dollar for dollar, to go into a bucket of a pool of capital that pays for the agronomic training, the varietal selection, the plant management, all the love that those coffee trees need to be able to thrive. And then lastly, just I guess the 2 key things. One, it's just embracing, and you all have put it very well this morning, embracing blended capital and kind of trying to kind of break down the mental barriers that we often see, that the private sector doesn't feel like that it's their responsibility to invest in this, as said, and the public sector doesn't want to, you know, subsidize corporate America, but it's actually bringing those 2 things together in a really in the golden triangle in that collaboration. The last one is blueprinting this, not just for other biblical scourges that are going to hit agriculture, especially at smallholder level, but going from coffee to quinoa, and we're in conversations with Kellogg's for quinoa, and with Costco and Walmart for cashew and Brazil nuts, and so on and so forth. So there's blueprints for collaboration. To Bob's question around how do you scale, and we could talk for hours about scaling around replicating our agricultural lending policy, practices and systems and so on for banks and so on. But this, I think, is even a more powerful way to scale, where you're blueprinting the collaboration.
Okay, great. Elizabeth? No?
I've always got something to add.
Okay, they said something. You know, I just wanted to get one more chance of somebody else from the again, the social entrepreneurship side. I don't know, is Neil Jeffrey here? Oh, Neil's here, yeah. And again, Jeff's working on water and sanitation for the poor. I mean, a big challenge, right? We're talking there about issues that are infrastructure in many of our minds. As bankers, we'd say, well, that must be a big infrastructure project, or it must take government intervention to be able to do that. It was the history of it in most of the world. How does this discussion fit into the work you're doing?
Great, thanks for the opportunity to speak. I just wanted to respond to some of the comments that were made, but also talk a little bit about the work that we're doing with Coca-Cola, which is really, I think, exemplary in terms of all the issues we've talked about here. So the issue was raised of whether we should be advisors or influencers or look for building models ourselves. And I think one of the pieces of work that we're doing with Coca-Cola, with the Coca-Cola Africa Foundation, is really fundamental in terms of that. So I was just in Daegu at the World Water Forum on Tuesday with your colleague Susan Maboya, the president of the Africa Coca-Cola Foundation, announcing a new scheme of which we will be a key strategic partner. So it's a $35 million extension to RAIN, which is the Replenish Africa initiative for 2020, and WASSUP will be providing 50% of that initiative. So it will build 4 million new services to low-income consumers in Africa, and we'll be doing half of that portfolio. But the really interesting thing about it, I think, is this mix of philanthropic capital and then what it means for the enhancement of core business activities. So the reason why WASUP was chosen as a partner and our reputation is built on our capacity to build the core business activity of utilities in emerging markets in urban environments. So, and there were some comments here earlier about what does the ecosystem look like, how does that enable us to be successful? So 10 years ago, when we walked into various of these markets in Africa, the companies said to us, so how are you going to assist us? So Jurama in Madagascar, for example, said to our engineers, there's no way we can sell water to poor people in Madagascar. We're a water scarce country, and anyway, these poor people don't want to pay. So our engineers worked with them through things like non-revenue water to reduce physical losses and commercial losses to enable them to have enough water, to save enough water, to provide 250,000 new services to low-income consumers. But not only as that, but also they started to get money from these people. So it completely shifted the way the company thought about services for low-income consumers. It became part of their core business activity. They started to make money from it, and they now themselves are raising funds to invest into this process. So the money doesn't need to come from us, they're doing it. So with Coca-Cola, what we're going to do is take that kind of model and then work in a bunch of other countries to then not only build services, but then build the capacity of those utilities so that there will be replication and they will start investing into the process. So it really struck me that it responded to a whole bunch of the comments we'd seen here today. And I'm sure a whole bunch of you know Sam Parker, who was the Skoll awardee last year, so I just took over for him as the chief exec at WASUP. But when I walked into Jurama and met the chief exec for the first time, so that's the utility in Madagascar. He shook my hand and he looked me straight in the face and said, Neil, the reason why we like working with WASUP is you're not an NGO. And I kind of thought, maybe I shouldn't disavow him of this concept. But it's really interesting because they see us as being critical to building their core business activity. And that's what he really meant. And that's the space we occupy, and that's why we assist them. And that's why the support of companies like Coca-Cola are just so helpful in getting us access into new markets to make that more possible.
So the role of the philanthropic capital, I mean, Peter kicked off with a whole range of finance. The role of the philanthropic capital for many of your social enterprises, are there examples of any of yours where you've really exited from that you've reached the scale that, others, impact investors and people talk about, where you've replaced it with, with pure financing and capital and still stayed a social enterprise? Because I'm very curious, because what we have found very often is in trying to achieve that, and I think Elizabeth and I have looked at most in microfinance at times, when those have tried to achieve that, they've often drifted a bit too in order to get a model that works for those, makes the numbers work. It's almost having to work backwards a little bit on that. But I don't know if any of you really have found that, because it sounds as though, for most of you though, you're coming into new roles to play around capital through this sort of joining up and partnering. But it's still a very key part, isn't it, in terms of funding for many of your organizations? I mean, if we can't pull that, please, and just, Frank, just let people know who you are too.
Hi, I'm Frank Altman with Community Reinvestment Fund USA. Citi is one of our investors, so. The answer is no. And I think it's really important as you look at scale to think about the types of capital and where it's necessary. And organizations that are trying to scale up, and I'm going back to your comments, Peter, philanthropy is crucial in most cases to organizations that are structured as nonprofits. The only way that you can grow a nonprofit balance sheet is through grants or retained earnings. And most organizations are putting the money on the street and not into growth. So it's important, I think, as we look at the scale issue to clearly define the different roles of capital. And I basically look at balance sheet capital and investment and capacity have to come from philanthropic support. Retained earnings, obviously organizations are trying to earn revenue as well. That gets plowed back into the organization. But it's not enough to grow a balance sheet for a financial organization to be able to go out and do more. And so grant capital is necessary for that. And when you have those two pieces in place, then the debt capital can start to come in. And it has to come in alignment. And I think this is probably one of the biggest factors or issues that stifle the bottlenecks you're talking about, is that you'll have one kind of capital that wants to come in, impact investors. Impact investors want to lend, but you can't lend infinitely against a balance sheet that can't support the debt. So then you get stuck. And I think this is, the people in the room, this is something to really think about in terms of financial institutions that are trying to grow at scale. We have just crossed in the last 3 years $100 million in small business loans, 55% to women and minority-owned businesses in low-income communities throughout the United States. And we're looking now at, well, how do we do the next 100 million? And we have all these constraints that I just talked about, investing in people, investing in growth, being able to be a sustainable organization. So I don't think that's the right question, actually. If you're talking about nonprofits, if you're talking about for-profit business models or government models, maybe there's a different question. But I think there's always going to be a need for some level of support at that corporate capacity building level.
And of course, whether you're for-profit or not, you're going to have a capital constraint. I mean, for all of us, we work backwards to where we can be, and then we have to prioritize what assets we have. And I think that's really where you begin, well, in banking, we might say our off-balance sheet activities. And in your world, very much, it's also about embedding the work you do in other people's businesses or governments or elsewhere. Just before I open just to questions, I wanted to ask, where Frank is sitting up here, I know, and you can't do this without talking about Frank DiGiovanni, because he's worked the whole spectrum, I think, of financing. He's just below the camera. Would you mind, Frank, your thoughts on this? Because, I mean, you've worked with, he's around the other way, Frank. In so many ways, Frank has worked with many of us at Ford Foundation here, both from the philanthropic and even the lending that Ford has done for many years in the U.S. as well as here, program-related investment and otherwise. But this question of really where this finance fits together, or doesn't.
Which part of that question, Bob, do you want me to answer?
Do you
want me to follow up
on Frank's in a way?
No, I think Frank has it right. I think that certainly we've seen in microfinance that when NGOs do exit from support from philanthropic capital, there is a huge issue of mission drift, and there have been very few who've managed to stay true to their mission, because once they start responding to shareholders with equity, there is a pressure to move away from serving very poor people to serving people who are at a higher income, and I think there's a real challenge. And I think Frank is right with certainly our sense from both our grant work and our impact investing work that NGOs find it very hard to grow their balance sheet with retained earnings. It's just the spread isn't large enough to do that, and most NGOs, I mean, we've certainly encouraged them to become more self-sufficient, and many of them do, as Frank's organization and many of the development finance institutions in the U.S. Their self-sufficiency does increase, but very few of them, even the biggest one, Self-Help, which now has crossed $1 billion in net worth, their net worth is about $450 million. They still need grant support for all the work they do in innovating new financial products. So if you expect innovation to occur, the innovation requires grant support. You're not going to do innovation with new product development out of retained earnings. It just isn't possible. So I think philanthropic support, Willie was talking about this model that he was developing around coffee rust. I mean, Willie, you needed philanthropic investment to provide you the long-term debt that you needed to invest in this. You weren't going to get market rate capital to do that. So I think it is important. And the grant support you needed to do the innovative planning came from philanthropic sources. So I think I think all of us who work for foundations need to expect to stay in the game for a long time. We shouldn't be thinking about exiting, I guess, is the real bottom line.
Right. There's some questions here on the aisle, and then to Jan after that, please. Or comments.
Hello, everyone. I'm Suzanne Gilbert with the SEVA Foundation based in Berkeley, California. This is a very interesting conversation for us because we got into the field of providing eye care services to people who are blind and work in over 20 countries. What we're finding is in countries that are developing a large middle income group, it becomes more and more possible for quality services for the entire community, rich and poor, to become entirely self-sustaining financially and organizationally. What we're using loan money for at this point is accelerating the growth of institutions that already are demonstrating their ability to retain earnings and continue to reinvest those earnings in expanding the program, their hospitals, their outreach programs, their vision centers in rural areas. But by having loan capital, they're able to more rapidly grow their network of community centers that then within 3 years become financially self-supporting. So there's definitely a philanthropic component, and there's a big role for that. And there's a growing role in more mature institutions of the kinds we work with for being able to use debt financing and pay it back. And we've done that through one vehicle called the I Fund through Deutsche Bank. And that fund, which was a loan fund, was also accompanied by a grant fund that would offer capacity building services to help ensure that the borrowers would become more robust with that loan funding and be able to pay the loans back, all of which is happening.
Thank you. Please feel free to direct any of the questions to the speakers as well. I mean, I think Jan, just behind you, just if you wouldn't mind, the lady with white hair.
Thank you for a great panel. And I just wanted to draw on Frank DeGiovanni's point. The others draw on another role of foundations because as he was speaking, I was reminded that the Ford Foundation came into one of the very first private equity funds ever to invest in locally owned financial institutions that would do small business lending in emerging markets, which as we know is catalytic to the formation and expansion of small businesses and equitable economies. And one of the roles that the Ford Foundation played as a shareholder was I thought of them as the mission shareholder because Frank unusually got permission to take a seat on the board of that first of its kind private equity fund. And he was the one who was always consistently setting the bar and challenging us to think about social impact, not in just measuring as in quantitative terms, but how are we reaching, who are we investing in, how are we thinking about this? And I think that role for foundations, having just completed the construction of another new and permanent financing vehicle, is critical. And so we've always tried in putting together shareholders to be sure that there is a foundation shareholder for this reason.
Mm-hmm. Maura, maybe just in front.
Hi, I'm Maura. I have a question for the panel. So thank you, Bob. You put together an amazing panel, and all three of you just have phenomenal histories and dedication and thought leadership. So what do you need from us or from others to be even more successful than you've been and to accelerate the kind of inspired work that you do?
In terms of, I mean, what?
Well, we come back to that.
Okay, that might be a good roundup one for us if we can. Can we do that? Good feedback. And where's the mic? Okay, the gentleman right there, and then we better run to the other side of the room if you want.
Hi, my name is Rod Dubitsky with BRAC USA. Reflecting on the comments that somebody had made about DIBS, we've been looking at DIBS ourselves, and our funding needs are very large. And in fact, I think there have been 0 DIBS closed, many case studies published, but actually 0 DIBS have closed, one soft launch of a small bond. And so what we're thinking about, I come from the private sector finance, thinking about how the swap market took off when ISDA was formed and swap standardization was created. So we're thinking about how BRAC, with 10 international countries, many programs, can help create a standardized template for DIBS. That template can then be shared potentially as open source, and then that can sort of help unlock this sort of inertia, this supply-demand inertia where people aren't interested because there is no track record, and potentially use that format to get more people involved in that. Everyone knows this is how the standard DIBS template could work. And that same philosophy can apply to all of these other sort of innovative financial instruments out there. I'm just wondering what the panel thinks about sort of creating a template of standardized documents for DIBS and maybe more generally across the innovative finance space.
Okay, we'll hold that to the wrap up too. There's one more to let them choose which one they want to respond to. Let me just give this one a chance over here. Let's run across the mic on there, and then we'll begin wrapping up.
Hi, I'm Yasmina Zaidman with Acumen, and again, just a great panel and great to hear about the work that you're doing. One of the comments that you made was about the need to go beyond capital and provide the resources and expertise and talent and networks that you can bring to the table. I think Coca-Cola is a great example of that. As you think about how do you support the growth of enterprises beyond capital, I think there actually is a cost associated with providing that technical assistance, or we call it post-investment management support, and I think there's a need for more thinking about how you structure that. How do you build technical assistance and support into the financing model? And I'm just curious if any of you have thoughts about how do you weave that in, whether it's through sidecars. Even I find, we're working now with both pro bono support, secondments from our corporate partners, also low bono support, and in some cases technical assistance grants. But even the pro bono has a cost, just facilitating that, managing that. So I'm just thinking, how do you create the financial model around all the non-financial resources that are needed?
Okay. I think we'll go back to the panel. And I'll let you choose which one of those you really want to respond to, or just your observations you've heard from those panelists, from more of the audience, and also the bringing in big money title. As I look at it across from me again, it's a very interesting question, having the comments that we've had from all of you about what beyond the capital is required. Elizabeth?
Yeah, sure. I think, one of the things that we've been talking about for the last hour or so is, what's the break point between things that can be financed with financially sustainable models and which ones can't. And I feel like we've been talking about these issues for some 20 odd years, and we're still a little black and white. You're either an impact investor or you're not part of the club. You're either financially sustainable or you're philanthropy. And we've sort of lost the notion of blended value, shared value. And I feel like we should be sophisticated enough to be nuanced and complicated and be able to accept a spectrum of preferences of both business model and investor that actually monetizes not just financial return and impact sort of bluntly, but enables us to monetize things like stability of return, length of return, impact, liquidity, all these different factors to create, a tailored portfolio of investors to meet the investors and the impact entrepreneurs' needs. So that would be the one thing I would say is, let's move away from the black and white into a spectrum that embraces lots of different approaches and things like that. And part of that is also so much discussion around it's either commercial returns or it's subsidized. Actually, 2 or 3% is pretty respectable these days. And when you think of the studies that have been done recently of venture capital funds that show that, on average, only a third of the venture capital funds even beat the public sector benchmarks, and none of them on average, returned, on the median, didn't return capital after fees and commissions. What does success look like? And let's be clear about what each investor wants in that equation. So that's the first. And the second thing I wanted to say is, again, coming back to the title of big money. One of the things, and actually I just wrote a blog about this recently. One of the things that's been striking to me is that I think we spend a lot of energy at this sort of grassrootsy end of the spectrum. No disrespect, Willie, to grassroots, or I don't know if Harold Rosen is here, to Grassroots Business Fund. But we've all been focusing on the smaller social entrepreneurship, the grassroots, the impact first, that end of the spectrum, which I think, frankly, has shown disappointingly little amounts of capital flowing to it because of the challenges of liquidity, of exits, of all the other things that we've discussed here. And what we're seeing is actually in the big money end of the spectrum, finally, we've got retail investors, family offices expressing interest in impact investing. So groups like the GIN and others have done a fabulous job in raising awareness, such that there's a lot of appetite for impact investments. But the problem is retail is showing up at Citi or Morgan Stanley or JP Morgan or Merrill Lynch saying, I want an impact investment, and there's nothing that those banking platforms have to offer that has the attributes that they would normally offer. They're not liquid, they're not listed, they're not audited, etc. So what the answer I've seen of the big money is putting together sector funds, water funds, forestry funds, renewable energy, even microfinance funds, where the underlying investment was not made with any intent to do social good at all. But the investor is investing because he wants his money or she wants her money invested in this social thing. So, I mean, that's not exactly impact investing, but I think it's okay.
Yeah.
And frankly, for me, the big money is flowing there to these sector funds. And if that's the gateway drug that gets people hooked on impact investing, then we can then pull them down towards the more social first, the smaller scale, more impactful projects, all the better. Yeah. So I'm just advocating for an embrace of all kinds of approaches, socially responsible investing approaches, impact approaches, big returns, little returns, commercial returns, you name it. Let's just get all this money flowing to make the world a better place.
Right. So thank you, Elizabeth. And we share many of those views. So that I'm, as a moderator, I'll wait to the end for it. Peter?
I think I'll take the standardization question to start. As the academic and quasi-historian, I think your point is very well taken. If you look at the history of futures markets, it was when contracts became standardized that you saw liquidity and depth. If you look at the junk bond market, or if you go 100 years or more than 100 years before in the preferred stock market, typically it is standardization that doesn't always guarantee success, but almost always is a precondition for success in terms of getting markets to be larger. So I think you're right on the money there. And I'm not going to repeat everything that you just said because Elizabeth said it so well, but living in the land of the second best is not so bad. And the second best may not be the pure organizations that we all like, but to the extent that we want to achieve social goals, there's a lot of organizations that being a Trojan horse within can lead to a lot of positive outcomes. So what I would use as a dean of a business school, it's great that we celebrate the social entrepreneurs who are here at Skoll. I think I'd love to be able to celebrate the corporations that are doing the same kinds of work, but in different organizations and with different outcomes and wear different clothes or whatever it might be. And to have my young people appreciate that we have to focus on the ends and the means are secondary. So I think I'll say that.
That's great. Thank you.
I think, let me pick up on your question. One of the discussions I've been having this morning with Citi and with Skoll was actually how we harness all this valuable resources that we all have, but it just doesn't all come in the same format. So how do I harness 700,000 employees across our business system who all want to contribute, but I need to build a whole separate organization to harness that and find a way of making that impact meaningful. How do we solve for that? I think that there is so much value out there. Of course, a lot of it is monetary, but how do you monetize it or how do you value it? Because so much of the resources that we all need to make the difference is actually not always in money form. It is in value in kind. It's in extraordinary skill sets that different organizations bring, and how do you bring that together? So I would say just be open to that, because I know through my own experience of working on 5x20 that we have so many different models that we're constantly experimenting with, piloting to try and see what works, different partnerships. And I think it's really important to think really big, but start small to make sure that you have the impact that you think, if you can measure it, that the impact you want to have, and find ways of bringing that together in different forms of partnerships. I mean, I mentioned Project Last Mile. We don't do that on our own. We bring that capability and that 85 years of business understanding of Africa, but we do that in partnership with USAID, we do it with the Global Fund, and we do it with the Gates Foundation. So there are different models that work, and they have we have committed collectively 21 million to take it to another 10 African countries in total. And that combines philanthropy, but inclines business knowledge. And it's very different models. So I think there's not one silver bullet. And I think we have to continue to share learnings and models. And I suppose any ask would be, let's try and share that best practice that works, because there are so many models, and they don't have to be big ones. They can be very small, but how do we collectively share that knowledge quickly so that we can work together to scale it and have the impact that we all want to have?
Well, this had very much the response I would have hoped in provoking the title there, and didn't want to come to our own conclusion, but it was very much around, we have to build on and utilize the platforms that are out there. Whether they're corporate distribution, as Charlotte talked about, whether even using it from a healthcare perspective, the Coke trucks that go everywhere, or others, that to repeat infrastructure and to do it, independently to make it for the sense of impact would be an enormous, unlikely scenario, realistically. But to leverage the expertise, the innovation that many of you have in the room as social entrepreneurs, with the intent, even as Elizabeth once said, I think very well, not even the intent, but the outcome and the purpose in terms of a capability of many others in the commercial sector that actually are doing work, as Peter said, haven't labeled it, and don't realize another attribute of what they're doing is expanding access and inclusion. And we knew this happened through the mobile telephony, right? It expanded dramatically with absolutely no donor money whatsoever. And the poor buying those phones and paying for that, you know, with becoming bigger tax revenues generators as a result, because it was such a value proposition. But that experience has allowed now to place on top of those platforms other services. And I think we just have to look at ways of integrating this knowledge and multiple platforms for services, including governments, of course. They're often the hardest, the slowest, the most challenging to do with, partner with. But you know, they have a mandate to do it in many cases as well, which none of us have quite the same mandate. So I thank everybody for participating. Edwin, who had to pop out, you know, with Skoll, who's been just instrumental, along with Graham, my colleague Macmillan here, in really helping to frame some of the thinking around this, but also your participation, and to the three speakers. Thank you.